My next guest has been warning for months of higher oil prices, and he owns several names that should benefit from them. For more, let's bring in Stan Majcher. He's portfolio manager at Hotchkis and Wiley. It's good to see you again, Stan. Welcome back.
Oh, thanks, Kelly.
Why do you think oil is finally responding?
I think it's a combination of a couple of things. I think, when you look at actions and words, the words were scaring the market, which was work from home, weak economy, EVs impacting demand, but those do factor into demand, but they're not strong enough to offset the demand, which has grown to what we're now consuming an all-time high for oil use worldwide. So I think some of the strength you're seeing is on the demand side, very strong demand, and then on the supply side, discipline from OPEC and discipline in the United States.
It's weird to me that we're talking about demand at the same time we're talking about deflation in China. So is it that oil demand is high, including China, because of China, in spite of China? Just explain these kind of conflicting signals we seem to be getting.
Sure. So I think it's in spite of China. I mean, we're seeing some weakness in China. We're seeing some weakness in diesel demand from trucking. But even with those factors, we're at an all-time high. So I think we've had some headwinds in terms of demand, but we're still seeing the underlying growth. So our belief was that we hadn't seen the peaks in demand and that it would be strong. Populations grow as people become wealthier. They demand more energy, and that energy comes from hydrocarbons.
You always are so good at kind of having these figures off the top of your head. I don't mean to put you on the spot, but I remember that global oil supply and demand is something in the range of like 103 versus 106 million barrels or something to that. Just how tight is the market globally?
Sure, it's roughly a little lower than that in terms of supply and demand, but we think currently the market is probably 1 million to 2 million barrels a day undersupplied seasonally. But the issue is really in the short term. We had some excess inventories. We released some from Strategic Petroleum Reserve. The difficulty is the long run. The world economy is growing. Years from now, we're going to need more than 102 million barrels a day. The issue is supply. Where's that supply going to come from? Where we see activity today over the next year, if activity stays where it is, it's hard to see any growth out of the U.S., which produces close to 20% of world liquids. OPEC is disciplined. A lot of other countries are seeing declining production. There's some offsets to that, but the difficulty is really the long run. So we think we've got a reasonably balanced market in the short run, which is why we see prices in the 80s. But the issue is the long run.
Right. And it's confusing because as an energy investor, you don't really want to be investing in companies with declining production. When Exxon's making a move to get into carbon capture or whatever, and when you have companies that, when the Permian just doesn't look as promising as it once did, the companies that you like, Cosmos, like you said, maybe some hidden assets. Baytex is Canadian. Marathon Oil, you're looking at LNG opportunities in West Africa. Can you even say, okay, I think oil is going to be structurally higher. I can just own the oil majors, or I can just own an energy ETF? Or is that going to kind of leave you holding the bag, so to speak?
I don't think so. I think the nice thing is that when you own these stocks, they're generating so much free cash flow, even at lower oil prices than where we are today. So they're generating a lot of cash. They're taking that cash and buying back stock, which isn't pricing in current prices. So we use, I think the crude is roughly $83. We're using $75. These companies are all generating 10 to 20% free cash flow yields. They're taking that 10 to 20% of their market cap, buying back stock. And so the free cash flow per share is growing pretty rapidly, even though production really isn't.
Yeah, I should note, you have a lot of financial exposure as well, some of the majors like AIG. So when you kind of take a step back and look at, I don't know what we call the market at this moment. Is it just taking a breather? Is it rotation? How would you explain to our viewers or to investors what you think is happening right now?
Yeah, so I've been doing this for over 25 years, and this is probably one of the most interesting markets. You have some very, very, very expensive stocks. We'd say some of the larger tech names look relatively expensive. What's driven the market this year looks expensive to us. And then on the other end of the spectrum, you have places like energy financials trading at single-digit multiples of earnings, so not 30 to 70 times earnings. That's the expensive stocks. We have companies that are single-digit, 7 to 10 times earnings, buying back stock, creating a lot of value for shareholders. So I think that there are some major risks in the market. The sovereign debt crisis potentially, overvaluation in very large companies. But there are parts of the market that are extremely undervalued that we're taking advantage of, where you can buy things at low multiples of earnings, and they're buying back stock, returning a lot of cash to shareholders. And that's a good thing no matter what market we have.
Right. And maybe it'll be their turn next to shine.